It is March 1st, 2026. And I have to say, just looking at the calendar, it feels like we are living in a completely different world compared to just a couple of years ago.
Oh, absolutely. It's night and day, really.
Right, because usually on this show, we like to look at trends that are, emerging, things that are a bit fuzzy and out on the horizon. But today we're looking at a reality that is arguably already arrived.
Yeah, even if the mainstream headlines haven't quite caught up to the structural depth of it yet.
Exactly. We are talking about the financial maturation of Bitcoin. And for everyone listening who has followed this space, you know how wild it used to be.
It is a fascinating moment in time to be looking at this, really. Because if you look at the last 2 years, the narrative has just shifted so completely.
It really has.
We aren't talking about wild speculation anymore. We aren't talking about, magic internet money in that pejorative sense.
Right, or the memes or the dog coins.
Exactly. No dog coins today. We're talking about what happens when a finite asset becomes the boring foundational layer of the global credit system.
Boring. That's an interesting word choice there, considering the price action we've historically seen.
Fair point.
But I get what you mean. You're talking about structural integration. But before we get into the plumbing of all that, I want to set the stakes for everyone listening. We have a number that I want to just drop right here at the top.
It's a big one.
It is. It comes from a joint report by UTXO Management and Bitwise. They're projecting institutional inflows by the end of this year, 2026. Do you want to do the honors and give them the number?
Sure. The number is $426.9 billion.
$426 billion. I mean, it's a number so big, it kind of just turns into noise.
It is completely abstract, isn't it?
It's really hard to wrap your head around.
Yeah.
So I looked this up before we started just to get some context for our listeners. That number is roughly the entire market cap of Samsung.
Wow.
Or if you want a different comparison, imagine the entire GDP of a country like Austria or Egypt.
Right.
And imagine all of that value flowing into one single asset in the span of just 12 months.
When you put it that way, it is actually a little terrifying.
It's a literal wall of money. And it begs the question, what happens when that kind of wall of money hits an asset that is famously finite?
Right, because there are only 21 million of these things ever.
Ever. And most of them are already lost or locked away in cold storage. So our mission today, for you listening, is to unpack this structural shift. We are going to go from the nitty-gritty of mining economics.
Because things have changed drastically down there.
Radically.
Yeah.
And we'll take that all the way up to the high-level game theory of sovereign adoption and legislation like the Bitcoin Act.
And we have a really robust stack of sources for this deep dive. We've got deep data analysis from Luxor Technology on the mining side.
Which is excellent, by the way.
It's incredibly detailed. We also have legislative texts like the Genius Act here in the US and the MICA framework in Europe. Plus, we're pulling research from Laser Digital Calamos Investments and of course, that UTXO management forecast we just mentioned.
So quick tone check for today. We are going high-level financial analysis. We want to be professional but accessible to you, the listener. We're avoiding the hype and focusing purely on the mechanics.
Structural mechanics, that's the key.
Okay, let's unpack this. I want to start in the engine room. Let's talk about the miners. Because I feel like if you don't understand what's happening with the supply, how the sausage is actually made, you really can't understand the price.
You definitely can't.
We are now exactly 21 months past the April 2024 halving.
Right, and just to reorient everyone listening, that was the moment the block subsidy dropped from 6.25 Bitcoin down to 3.125.
And looking back at the data from Luxor Technology, this period has been, well, brutal might be the word.
Transformative is probably the polite corporate way to say brutal, yes.
Transformative, sure.
But you're right, it has been an absolute gauntlet. Luxor identifies 4 specific forces that have defined this 21-month period. And understanding these forces is just crucial to understanding why the mining industry looks so fundamentally different today than it did in early 2024.
Walk us through them. What's the first one?
First, obviously, you had that deterministic 50% pay cut. You knew it was coming, right? It's hard-coded into the software, but it still hurts.
Yeah, imagine showing up to work on a Monday and your boss says, hey, great job, from now on, you make half.
I think most people would quit.
I quit immediately.
Right, but miners can't just quit easily. They have huge capital expenditures. Second, you had relentless difficulty growth. Since the halving, mining difficulty is up 71.8%.
Okay, for the listener who isn't, running an ASIC machine in their basement, what does difficulty actually mean in this specific context?
Think of it like a lottery. If you buy a ticket, you have a chance to win. Difficulty is essentially the casino adding more balls to the lottery machine. So you have to buy way more tickets, meaning spend way more energy just to have the exact same probability of winning that you had yesterday.
Got it.
So you're getting paid half as much, and it's over 70% harder to actually find the Bitcoin.
That sounds like a, frankly, terrible business model.
If you are prepared, it is terrible. And then the third force, which really caught a lot of people off guard, was transaction fees.
Oh, I remember this. Leading up to 2024, there was this huge bullish narrative, right? Ordinals, inscriptions, BRC20 tokens. Everyone was saying fees would skyrocket and totally compensate the miners for that subsidy drop.
Exactly, that was the hope. But the data shows the exact opposite. Fees are actually down 91.7% in total over this period compared to those hype cycles.
91%.
Yeah, the fee revenue just completely evaporated.
That is a massive miss on the revenue side for anyone building a forecast.
It is. And finally, the fourth force is just the standard price volatility. The standard deviation of price has been around $19,000. So if you are a miner today, you are operating in a highly capital-intensive, margin-compressed commodity business.
You aren't a tech startup anymore.
Not at all. You're an industrial commodity producer.
I used to think of mining as, plugging in a machine in a warehouse and just hoping for the best. It feels like those days are just completely long gone.
They're completely gone. If you plug in a machine and hope today you will go bankrupt in a month?
Right.
The Luxor analysis is fascinating here because it compares two distinct strategies that emerged: the spot miner and the hedged miner.
Okay, let's break that down for the listener. Start with the spot miner. How do they operate?
So a spot miner uses the strategy called FPPS, full pay per share.
Okay, you're going to have to unpack that acronym for me. FPPS.
Sorry, yes. It basically means you get paid for every ounce of work your machine does instantly at the current market rate.
Okay, so it's strictly pay as you go.
Exactly. You mine today, you sell today. You are fully exposed to the difficulty spiking and the fees crashing. If the weather is bad, you get wet.
And the hedged miner, how are they different?
The hedged miner treats hash rate like a true commodity, like corn or oil. They use rolling hedges, they sell forward contracts.
I want to make sure I really get this. Because rolling hedges sounds like something Wall Street guys shout about on a trading floor. Give me a concrete analogy.
Sure. Think of it like a farmer.
Okay.
If you grow corn, you can harvest it in October and sell it for whatever the spot price is that day. That's spot pricing. You're completely at the mercy of the market.
And if the price of corn crashes on harvest day because everyone else is also selling hash rate probe, I'm in deep trouble.
Exactly. But a hedged farmer sells a contract in, say, May that says, I will deliver this corn in October for X price. They lock it in.
So they surrender the chance to make $1 million if corn unexpectedly skyrockets, but they guarantee they won't go broke if it crashes.
Precisely. Now apply that exact logic to Bitcoin hash rate. The 5-month roll strategy means the miner is constantly selling contracts to deliver hash rate 5 months from now. And here's the absolute kicker in the data. The market was pricing those contracts higher than reality turned out to be.
Wait, so the buyers were overpaying?
They were paying a premium for certainty. The buyers severely underestimated how much difficulty would actually rise, so they paid a premium to lock in hash rate today.
I see.
The miners who sold that hash rate locked in that premium. When difficulty actually spiked much higher than the broad market expected, the spot miners got crushed, but the hedged miners were fully protected.
So the hedged miners were essentially getting paid for a cleaner, easier network environment than the one that actually existed in reality.
That's a really great way to put it, yes.
Give us the actual numbers from the report. How much better was this hedging strategy?
From May 2024 to January 2026, BTC-denominated rolling hedges beat spot mining across the board, every single time frame.
Wow.
The clear winner was the 5-month roll strategy. It returned 14.7% more than spot.
Wait, almost a 15% alpha, just from financial structuring.
This is from structuring. No new machines, no magically cheaper electricity, just strictly better math.
That's incredible.
To put it in real-world terms, if you had a 1 exahash operation, which is a very decent-sized industrial farm, and you ran a simple spot strategy, you earned 374 Bitcoin over that period.
Okay, 374.
If you ran a 5-month rolling hedge, you earned 429 Bitcoin. That is 55 extra Bitcoin.
55 Bitcoin. At today's prices, that is a staggering amount of money.
It is.
That's literally the difference between healthy profitability and bankruptcy for some of these marginal firms.
Absolutely. But they use the money from those new shares to buy so much Bitcoin that the actual amount of Bitcoin attributed to your single share goes up, then you have won.
Oh, I see. So even though my percentage ownership of the overall company is technically smaller, my one share now represents a larger chunk of actual Bitcoin.
Exactly. That is accretive value. It's a brilliant way of using the traditional public equity markets to capture more scarce Bitcoin than you could ever buy with just your standard operational revenue.
It's basically a financial engineering loop.
It is financial engineering, but crucially, it's backed by a verifiable hard asset.
And the accounting rules finally changed to actually allow this to happen smoothly.
Yeah.
That was a massive hurdle before.
A completely prohibitive hurdle. The FASB rule change in January 2025 allowed fair value accounting.
Which means
Before that change, if you held Bitcoin and the price dropped even for a day, you had to take an impairment charge on your books. You had to report a financial loss.
even if you didn't sell a single coin.
Even if you didn't sell. But if the price went back up and doubled, you couldn't record that gain on your books until you actually sold it. It was completely asymmetrical accounting.
All risk, no reward from
Okay.
an optical standpoint.
Exactly. It was an absolute nightmare for any CFO trying to report quarterly earnings to Wall Street.
Good down.
Now, with mark-to-market accounting, you just show the true current market value of your holdings at the end of the quarter, up or down. That single rule change removed the massive headache for corporate CFOs to enter the space.
So companies are confidently treating it like a pristine reserve asset. But reading through the laser digital analysis, there's a much deeper theoretical shift happening here beneath the surface.
Yes, the macro theory.
They call it the fixed-incomization of Bitcoin. Now I have to stop you there before we dig in. Fixed income. We're talking about Bitcoin. This is the asset that famously drops 20% because an eccentric CEO tweets a picture of a dog.
I know.
How can anyone with a straight face put the words Bitcoin and fixed income in the exact same sentence?
It sounds completely ridiculous at first glance. I fully admit that. It sounds like an oxymoron. But you have to look closely at who is actually holding it now versus 5 years ago, and critically how they're holding it.
Okay, convince me. Walk us through the laser digital thesis.
This is probably the single most profound intellectual shift we are seeing in the space right now. For a solid decade, Bitcoin behaved purely like a growth tech stock. High risk, high reward, highly correlated with the Nasdaq.
Right, if tech stocks crashed, Bitcoin crashed harder. It was a classic risk-on asset.
Exactly. But Laser Digital argues with strong data that it is actively transitioning to a fixed income or reserve asset behavior. And to truly understand this, we have to look at a concept called Exter's pyramid.
Exter's pyramid. That honestly sounds like an artifact from an Indiana Jones movie. Paint a picture for us. What is this pyramid?
I want you to visualize an inverted pyramid, a massive, incredibly heavy triangle balancing precariously on its tiny, sharp tip pointing downward.
That sounds incredibly unstable, physically speaking.
That's precisely the point of the model. This is John Exter's visual model of the global financial system. At the very top, the widest, heaviest part, you have the most abundant but most risky assets.
Like what?
Derivatives, unfunded government liabilities, complex paper promises. We're talking quadrillions of dollars of value that essentially just exists as digital entries in a database somewhere.
Okay, so that's the massive crushing weight at the top. What's below that?
As you move down, the pyramid narrows and the assets get theoretically harder but much scarcer. Below the derivatives layer, you have real estate, then equities, then government bonds, then cash.
And what is the tip? What is the tiny pinhead holding up this entire quadrillion-dollar structure?
Historically speaking, gold. It was the only financial asset with absolutely no counterparty risk. If I hold a physical bar of gold, I don't need you to fulfill a promise or stay solvent for it to have value. It just intrinsically is.
But we officially went off the gold standard decades ago.
We did, and this is Laser Digital's core argument. When we removed gold from the base, we essentially replaced the tip of the pyramid with sovereign debt. U.S. treasuries mostly.
Right.
We tried to balance the entire global economy on the promise that governments would always pay their bills and never inflate the currency.
And given the sovereign debt clocks we're seeing right now globally, that tip is looking more than a little fractured.
It is highly liable to debasement. It simply isn't hard money. So where does Bitcoin fit into this?
The laser digital argument is that Bitcoin is systematically sliding into that bottom tip. It is slowly replacing both gold and sovereign debt as the ultimate hard, pristine collateral.
And this directly connects to a fascinating prophecy from Hal Finney Wright. way back in 2010.
It is genuinely spooky how accurate he was. Back in 2010, Hal Finney wrote on a forum that he saw Bitcoin ultimately becoming a high-powered money reserve for banks.
High-powered money, right. He explicitly said that banks would end up issuing their own digital cash, which would be lighter weight and more efficient for daily use, but it would be fully backed by underlying Bitcoin reserves held in vaults.
And that is quite literally what we just talked about with the Genius Act and the new wave of regulated stablecoins.
It is exactly what is happening in real time. Tether's USAT or other compliant stablecoins are the lightweight digital cash Finney predicted. They are fast, cheap, and easy to move around. But the ultimate collateral backing them, the high-powered money sitting at the base, is increasingly going to be Bitcoin.
So if Bitcoin truly becomes the base layer of the pyramid, what does that structurally do to the price?
This is where a concept called the multiplier effect comes in. Laser Digital did some really extensive math on this. Bitcoin has a fiat multiplier significantly greater than 1.
Why is that?
Because of what we call the low float. Long-term holders and these massive institutions tend to acquire it and immediately lock it away. They put it in deep, cold storage and literally forget about it.
They aren't day trading it on Binance.
Exactly. Because of that behavior, only about 25 to 30% of the total mine supply is actually liquid or available for sale on exchanges at any given moment.
Wow, that's tight.
So when a fresh dollar of fiat comes into the market to buy Bitcoin, it doesn't just raise the total market cap by $1, it raises it by much more. Because the available supply is so incredibly inelastic, you have to bid the price up significantly to convince someone to part with their coins.
So small, consistent fiat inflows create disproportionately large price jumps.
Exactly. And Laser Digital estimates that if the massive global fixed income market, and we're talking over $100 trillion of capital globally, if they allocate just 0.5%, half of 1% to Bitcoin, the multiplier effect could easily add trillions to Bitcoin's total market cap.
Just 0.5% allocation.
Just 0.5%. Because that specific type of institutional money isn't trading, it's allocating. It buys and it sits for decades. It permanently takes supply off the active market. This fixed-incomization effectively removes Bitcoin from circulation, making the remaining tiny liquid float exponentially more expensive.
It creates a massive reflexivity loop.
A highly powerful feedback loop. As the fiat price rises, it becomes a more stable and better collateral asset, which then allows for more safe credit creation on top of it, which in turn drives even more structural demand for the underlying collateral.
It's a flywheel.
An incredible flywheel.
Which brings us perfectly to the biggest whales of all in this ecosystem, the sovereigns. We briefly mentioned the nation-state inflows in the UTXO forecast, but there is actual concrete legislation moving this forward in the U.S. right now, the U.S. Bitcoin Act of 2025.
This is arguably the game changer on the macroeconomic and geopolitical stage. The core proposal is for the establishment of a formal strategic Bitcoin reserve, or SBR.
What are the actual mechanics of that?
Yeah.
Is the U.S. government literally going to open a Coinbase account and start hitting the buy button?
Essentially, yes, though a bit more formalized. The act legally mandates the U.S. Treasury to aggressively acquire 200,000 Bitcoin per year for 5 consecutive years.
Okay, so that's a target of 1 million Bitcoin total?
Exactly, 1 million Bitcoin.
That is nearly 5% of the total supply that will ever exist, held by one government.
Roughly, yes. And the funding mechanism they outlined is quite clever. They plan to use the accounting revaluation of historic gold certificates and Federal Reserve remittances to fund the purchases without technically increasing the deficit.
Fascinating.
But the immediate market impact actually comes from a different provision regarding seized assets.
Oh, right. The Bitcoin the Department of Justice seizes from criminals. The Silk Road coins, the Bitfinex, Hacker Stash, all that stuff.
Right. Historically, the U.S. Marshals Service would just routinely auction those seized coins off to the highest bidder. They would dump tens of thousands of coins on the open market, suppressing the price and creating huge anxiety.
Right. I remember the market always bleeding leading up to those auctions.
Well, the Bitcoin Act explicitly says no more auctions, ever. The roughly 198,000 BTC already held by the DOJ moves immediately to seed the new strategic reserve.
So that looming sell pressure just vanishes instantly overnight.
Gone. And the U.S. government becomes a massive permanent supply sink. If the federal government publicly signals it is going to buy 1 million Bitcoin over 5 years, front-running the U.S. Treasury becomes the most obvious and profitable trade in the history of finance.
Oh, wow, yeah.
If you are the state treasurer of Texas, you want to buy your allocation right now before the feds drive the price to the moon with their mandated buying.
And if you extrapolate that,
Yeah.
if you are another sovereign country, if you are China or Russia or the EU,
The exact same brutal logic applies. We are currently seeing a sovereign hedge dynamic play out globally. The U.S. dollar's share of global reserves has already dropped to 58%.
which is historically low.
Very low. You have severe currency inflation in places like Turkey and Nigeria driving massive grassroots citizen adoption, which violently forces their central banks to pay attention and adapt.
And gold plays a role in this transition too, right?
Yeah.
The Bitwise report touched on that.
Yes, the base case scenario outlined in the Bitwise report suggests a very plausible move where global central banks simply swap just 5% of their existing physical gold reserves for Bitcoin.
Just 5%.
Just 5%. A minor portfolio rebalancing. But that alone results in $161 billion of immediate structural buying pressure.
That's massive.
They aren't even selling their dollars in this scenario. They are just diversifying their hard assets. They are essentially modernizing the absolute base of their own Exter's pyramid.
It really feels like a race. A silent global race to accumulate the finite, pristine collateral before everyone else figures the math out.
It is a frantic accumulation race. But there's one final piece to this macroeconomic puzzle that makes it truly sustainable for the long term. Because as we touched on earlier, institutions and pension funds, they can't just buy a digital rock and watch it sit in a vault. They absolutely need yield.
Right, they have actual human retirees to pay every single month. They need reliable cash flow. A rock of gold in a vault doesn't pay a quarterly dividend.
Exactly. And this brings us to section 6 of our deep dive, the yield opportunity. Or as the industry is calling it, BTCfi, Bitcoin finance.
How big is this specific opportunity according to the data?
The report projects a minimum $100 billion structural opportunity over the next few years.
Okay, so how do you safely get yield on Bitcoin without taking crazy counterparty risks? Because I vividly remember the dark days of Celsius and BlockFi.
We all do.
That did not end well. Retail people lost everything chasing a 5% APY.
No, it was a disaster. And that is exactly why the infrastructure and regulatory frameworks we discussed earlier, MiCA the Genius Act, were so critically important. We aren't talking about blindly lending your Bitcoin to an unregulated guy named San operating out of a penthouse in the Bahamas anymore.
Thankfully.
We are talking about true Bitcoin native yield. Things like programmatic lending on decentralized layer 2 networks, or providing automated routing liquidity to the Lightning Network. But also importantly, traditional financial structuring is entering the chat. Calamos Research released a fascinating paper on protected Bitcoin strategies.
Protected. Now that sounds very appealing to a risk-averse pension fund manager. How does it actually work?
They utilize deep options markets to tightly structure a position. It's mathematically complex behind the scenes, but essentially they buy spot Bitcoin and simultaneously buy financial insurance, specifically put options against the asset dropping below a certain price.
So you mathematically can't lose more than, say, maybe 10 or 20%, or nothing at all.
Exactly. You can customize the structure to have 80 to 100% absolute downside protection. You strictly cap your maximum downside risk, but you still capture a very significant portion of the upside price appreciation.
Well, it changes the institutional allocation math completely.
It really fundamentally does. Calamos strongly argues this specific protected structure allows highly conservative portfolios like the classic 60-40 stocks and bonds portfolio that every retirement account uses to safely allocate up to 10% to Bitcoin.
10%. That is totally unheard of. Usually traditional financial advisors say 1% max, or maybe 2 if you're feeling wild.
Yes, historically. But if you have guaranteed downside protection, it doesn't wreck your portfolio's mandated risk profile. You are effectively replacing some stagnant equities or low-yield bonds with a heavily protected Bitcoin position. You get the explosive growth potential of the crypto asset class with the sleep-at-night safety profile of a traditional government bond.
And that right there is the pure definition of fixed-incomization. It ceases to be a speculative gamble and becomes a boring yield-bearing asset.
That is what I call the boring bull case. When Bitcoin completely stops being a volatile casino chip, you trade aggressively on weekends and simply becomes the boring yield-bearing bedrock of a teacher's pension fund. that is when the true hyper-Bitcoinization actually occurs.
It just blends into the background.
Right, it becomes practically invisible because it is structurally everywhere.
So let's try to synthesize all of this for the listener. Because we have covered a truly massive amount of ground today, from hashing rigs in Texas to sovereign wealth funds in the Middle East.
Let's absolutely connect all the dots here.
It fundamentally starts with the supply shock. The 2024 halving permanently cuts the daily supply. Miners are forced to stop gambling and start aggressively hedging, which completely professionalizes the industry. They transition into disciplined commodity producers, not wild speculators.
Right, the engine room gets cleaned up.
Then regulation forcefully steps in. Frameworks like MiCA and the Genius Act build the safe, auditable rails. No more Wild West, no more catastrophic, unpunished rug pulls.
Which critically unlocks the massive institutions.
Right, there's the $426 billion wave of capital. Nation-states, elite wealth managers, and public corporations aggressively adopting the Bitcoin standard as a treasury reserve.
And because of the multiplier effect of the low float and the fixed-incomization strategies, that money gets permanently locked away at the absolute bottom of Exter's pyramid.
It stops circulating.
Exactly. It doesn't freely circulate, it supports. It mathematically holds up the rest of the vast global credit system above it.
Which simply creates an unstoppable feedback loop of steadily higher fiat prices, vastly better collateral utility, and even wider global adoption.
Exactly. It is a perfect compounding storm of structural financial maturation.
It's just incredibly fascinating to think about in those terms. We all so often obsess over the hourly or daily price candles on Twitter, but the real historic story here is this underlying plumbing, the quiet, permanent rewiring of the entire global financial engine.
It is. And that actually leads me to a final, slightly provocative thought for the listeners to ponder.
Oh, I love a provocative thought. Let's hear it.
If Bitcoin actually functionally replaces gold at the bottom of Exter's pyramid, if sovereign nations start issuing digital currency that is verifiably backed by it, an immense global credit is created securely on top of it, does the very concept of inflation fundamentally change forever?
Change how? What do you mean by that?
Well, think about it. For the last 50 years since we left, the gold standard monetary policy essentially meant a small group of humans subjectively deciding exactly how much money to print. A closed room of people at the Fed arbitrarily deciding the future purchasing value of your dollar.
Right, human discretion.
But if the base layer collateral of the global system is Bitcoin, which is mathematically finite, perfectly predictable, and entirely unchangeable by any human committee, are we basically witnessing the end of subjective monetary policy and the dawn of objective monetary physics?
Monetary physics. I absolutely love that term.
We are actively moving from a fragile system based entirely on human trust and government decree to an anti-fragile system based purely on mathematics and thermodynamic energy. And if that profound shift is truly happening, the crazy price volatility we still see today is really just the temporary friction of that massive transition.
The growing pains.
It's the geopolitical tectonic plates violently grinding against each other as they permanently shift into a new alignment.
That is really something deep to chew on. Monetary physics. It is truly a brave new financial world we're stepping into.
It certainly is. We are watching history.
And for those of you listening who really want to dive deeper into the raw data, because we honestly just scratched the surface of the rolling hedge math and the highly specific legislative text today, we highly encourage you to go directly check out the original source materials from Luxor Technology, UTXO Management, Chainstack, and Laser Digital.
I'd add, the Luxor report specifically is an absolute masterclass in modern mining economics. It is highly recommended reading if you really want to intimately understand the engine room of this network.
Absolutely second that recommendation. Thank you all for joining us on this deep dive into the true financial maturation of Bitcoin. It is 2026, and the economic future is looking surprisingly fixed and boringly profitable.